Okay, let's unpack this. Good morning, and welcome to Bulls, Bears, and the Bell Morning Edition.
hmm
If you're looking at the market today, well, it's definitely not moving as a monolith. It's quite literally a fundamental struggle. You've got two completely opposing forces, and how they play out, the next few hours, that's going to define the entire session.
That is the perfect way to frame it.
Yeah.
You have to navigate this massive chasm today. On one side, you've got widespread, almost coordinated, you could say, global macroeconomic anxiety. You see it in the futures markets, all pointing lower. And that's mostly down to one high-stakes piece of U.S. data, the core PCE inflation report.
Right, the big one.
But then on the other side, you have these highly specific, catalyst-driven, micro-level opportunities. I mean, stocks like Data Vault AI, Open Door, they're showing extreme bullishness. It's like they're completely detached from that global gloom.
And that tension, that's really our entire mission for this deep dive, isn't it?
Yeah.
Decoding that struggle, giving you the critical knowledge to, well, understand which way the wind is truly blowing. The central tension is palpable. You can feel it. We're seeing risk-off signals everywhere in global futures, like you said, a direct result of fear around that Fed-preferred inflation gauge. But then you look over at the movers list, and I mean stocks like Data Vault AI, DVLT, it's up approaching 50% pre-market.
Incredible numbers.
And Open Door, up significantly too. The volatility, confirmed by an elevated VIX, that's the only certainty, which means today's trajectory, it's really going to be determined by which of these two forces wins out. Is it the macro caution or that micro exuberance?
And if you just look at the broad market right now, the signal is definitely caution. We are seeing what we'd call a coordinated global risk-off signal.
Okay, let's turn to those macro headwinds then, because as you mentioned, it's not just isolated here in New York. This feels like a synchronized global de-risking event. Can you walk us through what's happening across the major futures landscape right now?
Yeah, absolutely. We are seeing an unambiguous, synchronized global apprehension. And that word synchronized, it's really key here. This isn't just one nervous corner of the market. It feels coordinated. U.S. index futures, all pointing lower. They're anticipating a cautious open. You look at the Dow Jones futures, the S&P 500, the NASDAQ 100, all trading in the red. Investors are, well, clearly choosing to lighten up or maybe hedge ahead of that critical 8:30 a.m. ET data release.
But our sources, they highlight a particular point of weakness that maybe tells a more specific story about the underlying economy, the Russell 2000.
Precisely, yeah. The most pronounced weakness, you can really see it in the Russell 2000 futures. That's US 2000. It's currently showing a decline of nearly 1% pre-market. Now, why is this decline so much steeper than, say, the S&P 500 or the NASDAQ?
Right.
Well, it's because the Russell 2000 tracks smaller, more domestically focused companies. These businesses, they're structurally quite different from the tech giants, right? They're often the most vulnerable to two major factors: higher interest rates and a tightened credit environment.
So this is kind of a signal about like Main Street vulnerability then.
Absolutely. Think about the debt maturity wall we hear about. Many smaller firms, they borrowed heavily at really low rates over the past few years. As those loans mature and they have to refinance in today's, well, much higher interest rate environment, their balance sheets suddenly look a lot shakier. And furthermore, they're highly dependent on domestic consumer health and critically regional bank lending. So their outsized decline, it really signals acute concern about the foundational health of the U.S. economy, especially, the consumer and small business sectors. They're often the first to feel the pinch of tightening policy.
And this U.S. caution, it just spills out internationally almost immediately. It feels like this one U.S. data point has these massive global consequences.
It does, yeah, and it's a direct domino effect, really driven by liquidity. The bearish tone, it was set earlier in Asia. You had Japan's Nikkei 225, Hong Kong's Hang Seng Index, both posting significant declines. That negative sentiment just carried right over into Europe. Germany's DAX, the UK's FTSE 100, both trading lower in their sessions. Which leads us back to that core question we asked earlier. Why is a single U.S. inflation number causing this, synchronized global sell-off?
Okay, let's dig into the mechanical why of that. How does it work?
Right. It's all about proactive pricing in of global risk. And it's tied directly to the U.S. Federal Reserve. The core PCE report, it directly influences the Fed's monetary policy path. That's the key link. So if a high PCE reading prompts the Fed to be more hawkish, hiking rates or keeping them higher for longer, that action strengthens the U.S. dollar, often dramatically. And a strong dollar plus higher U.S. rates, that tightens global financial conditions right across the board.
Wow.
So foreign governments, emerging markets, international companies that have dollar-denominated debt, suddenly they see their borrowing costs spike and their local currencies weaken. So international investors, they aren't reacting out of sympathy. They are actively de-risking and hedging against what feels like an inevitable global drag caused by a potentially hawkish Fed.
Okay, that explains the global synchronization piece.
Yeah.
Now, you mentioned the VIX earlier. To sort of corroborate this pervasive anxiety, we have to look at the CBOE volatility index, right? The VIX, the so-called fear gauge.
Yeah, the VIX is definitely confirming the fear. It is trading up this morning. It's risen over 3% pre-market, and it's holding above 16. This upward move, it's a classic sign. It tells us institutional investors are actively purchasing protection, probably buying put options ahead of a known high-impact event risk, like this core PCE release.
But let me just challenge that for a second. A VIX at 16. I mean, it's higher than yesterday, sure, but it isn't exactly signaling, outright panic, is it? During real market crises, don't we see the VIX spike way higher, like into the high 20s or even 30s? So does a VIX around 16 truly indicate fear, or is it just sort of standard pre-data hedging?
That's a really crucial distinction to make. You're absolutely right. 16 is not panic territory, not at all. It signals caution, yes, and acute uncertainty, but not capitulation. It tells us that investors recognize this 8:30 a.m. data point is kind of binary. It could trigger a major move, up or down, and they're simply not willing to take a massive directional bet without some protection in place. It reflects, optionality pricing more than systemic collapse fear. The market knows something big is coming, but they haven't decided yet if it's going to be a bull market party or a bear market route. So yeah, they're buying insurance while they wait.
Okay, here's where it gets really interesting then. Because all that global de-risking we just described, it feels like it's all holding its breath for this 8:30 a.m. ET data dump. This is the pivot point, the core PCE inflation verdict.
This truly is the main event, not just for today, arguably for the whole week. The core PCE price index, both the month-over-month and the year-over-year figures for August, this is the Federal Reserve's absolute preferred inflation gauge. The average listener might hear more about the CPI, the Consumer Price Index.
All right, that gets more headlines usually.
It does, but the Fed, they focus intensely on PCE.
Can you explain that distinction quickly? Why does the Fed prefer PCE over CPI? What's the difference?
Sure. Well, the PCE is generally considered a superior measure of overall inflation for a couple of technical reasons. First, it uses a broader basket of goods and services. It includes expenses paid by businesses on behalf of households, like certain healthcare costs, which CPI doesn't capture the same way. Second, and this is really critical, it uses what's called a chain-weighted index, not a fixed basket like the CPI. This means it dynamically captures substitution effects. So, if the price of beef goes up dramatically, consumers naturally substitute chicken. The PCE reflects that change more quickly.
Ah, so it reflects actual behavior better.
Exactly. The CPI is slower to adjust. That makes PCE a more realistic gauge of how consumers actually behave when prices change. And look, if the Fed is using it, the market has to use it.
Okay, makes sense. So what are the specific numbers we need to watch for this morning? What's the consensus expectation?
The consensus is actually quite tight, which paradoxically increases the volatility risk around the release itself. Analysts are expecting a pretty modest 0.2% increase month over month and a 2.9% year-over-year rate. The key focus, though, will be on that core number, the one that strips out the volatile food and energy components. Any deviation from that 0.2% month-over-month consensus, that is going to trigger massive, almost mechanical volatility, especially in the Treasury market.
All right, let's break down the two sort of binary scenarios that are likely to define the trading day. Let's start with the bearish outcome, the one the futures market seems to be pricing in right now.
Okay, scenario A, bearish. This gets triggered by a reading above that 0.2% month-over-month consensus. Let's say it comes in at 0.3% or even higher. If that happens, well, it validates the current risk-off sentiment we're seeing. It confirms that inflation is stickier than people hoped. It suggests that the last mile of inflation fighting is going to be incredibly difficult. And this gives the Fed basically every reason to maintain a hawkish stance, maybe keep interest rates higher for longer than expected. The immediate reaction you'd likely see, a spike in bond yields. The 2-year Treasury yield, which is hypersensitive to Fed policy, would probably jump. The U.S. dollar would strengthen. And growth stocks, especially those dependent on high future cash flows that get discounted back at higher rates, they would likely plummet as that negative sentiment just accelerates across the board.
Okay, that's the downside. And the scenario everyone is kind of hoping for to trigger a sharp reversal,
Yeah.
the dovish pivot idea.
Right. Scenario B, bullish. This happens with a reading of exactly 0.2%, or ideally even lower, like 0.1%. This is the dovish pivot rally fuel. It suggests inflation is moderating right on target. The trajectory towards the Fed's long-term goal seems intact. This outcome would give the central bank much greater leeway to, say, pause their tightening cycle, or maybe even start discussing future easing down the road. If we get that 0.2% or lower, we could see a really powerful reversal. Futures flipping from negative to positive almost instantly. Bond yields falling sharply as fixed income traders price out future rate hikes, and just a broad tailwind for the entire equity market, especially those high multiple technology stocks that really thrive on lower discount rates.
Got it. But the BCE doesn't come alone, does it? We also get that critical, simultaneous check on the consumer's financial health, personal income and personal spending figures.
That's right. And these figures are crucial for understanding the sort of real-world application of the inflation data. Consensus for August is for personal income to rise 0.3% and personal spending to rise 0.5%. Ideally, the market wants to see these numbers moving roughly in tandem.
And what if they diverge? That's where the analysis gets a bit more complex, right?
Exactly. The critical question here is looking for that divergence, specifically strong spending fueled by weak income. That's the worry. So if we see spending come in really strong, say above 0.5%, but income is weak, maybe falling below that 0.3% forecast, well, that is a major red flag. It suggests consumers are keeping up the consumption levels not through wage growth, but by draining their pandemic-era savings, or worse, taking on more debt.
Which isn't sustainable.
Not at all. Strong spending fueled by weak income signals a potentially unsustainable trend that will eventually hit a wall. And that likely triggers a sharp recession when credit conditions finally snap. We've already seen credit card utilization rates rising significantly, so this data point is essentially a check on how much longer the American consumer can keep this, well, arguably unsustainable engine running.
Okay. And then later in the morning, 10:00 a.m. ET, we get a final reading that looks not just at past spending, but future intentions. The University of Michigan Consumer Sentiment Survey.
Yeah, that 10:00 a.m. report gauges confidence, their outlook for the economy. It's always important. But the market and the Fed, they pay particularly close attention to one embed component within it. That's the part that measures consumer inflation expectations.
The psychological aspect.
Exactly. The market often fears that inflation expectations can become a kind of self-fulfilling prophecy. If consumers believe prices will rise sharply next year, they might rush out and buy durable goods now, which, ironically, increases current demand and actually drives up prices further. So any upward revision to the preliminary inflation expectations reading that came out earlier, that will be scrutinized by the Fed as a serious risk factor.
And then finally, the Fed itself gets to weigh in today, adding another layer of complexity. We have commentary scheduled from FOMC members Barkin and Bowman.
Yes, and their speeches are critically timed because they happen after the morning data deluge. Their words will be the first chance for the market to really gauge the Fed's initial, maybe even official reaction to the PCE and the consumer spending data. If the data itself is a bit ambiguous, their commentary could provide the necessary clarity. It could amplify or maybe dampen the market's initial, probably chaotic response. For instance, if PCE comes in hot, which is bearish, but then Barkin suggests, 1 month of data won't change the long-term outlook, that might actually mitigate the sell-off somewhat. So it's essential to listen for any shift in their language or any subtle hints about their future voting intentions.
Okay, now let's talk about the complete contradiction we mentioned right at the start, the micro-bifurcation. Because despite all this global macro fear futures pointing down, the VIX creeping up, the world holding its breath for inflation beta capital is just intensely flowing into these catalyst-driven special situations. This really feels like a stock picker's paradise today.
It really is the dynamic that makes this market environment so, well, challenging, but also fascinating. The market is actively differentiating between that broad systemic risk and these pockets of isolated alpha. Investors seem to be signaling macro fear by, say, pulling money out of broad-based index ETFs, but at the same time, they're pushing it aggressively into specific companies where the news is just too transformative or too compelling to ignore. They're separating the signal from the noise, you could say.
And nothing screams transformative quite like Data Vault AI Inc., DVLT. This is the standout gainer this morning, isn't it?
DVLT is absolutely exploding. Yeah, we're seeing pre-market gains approaching 50%, and the share volume is rocketing into the hundreds of millions. Now, to put this in perspective for you, this is a micro-cap company. Its market capitalization was previously well under $100 million. The catalyst is just massive.
Yeah.
A transformative $150 million strategic investment from Silex holding company SCLX. This infusion of capital fundamentally alters DVLT's financial stability. It gives them resources far, far beyond their current size.
But the truly intriguing detail, the one that maybe tells the story about the current speculative environment, is how Silex is making that investment.
Yes, exactly. Silex will make the investment, at least in part, in Bitcoin. Now, that is highly unconventional, to say the least. It signals a couple of things, I think. First, that this microcap company is completely bypassing the traditional, often slow-moving capital markets. They're not waiting for banks or traditional institutional financing. They're using an unconventional asset to fuel what they see as radical growth. Second, it connects DVLT to two of the absolute hottest, most speculative narratives right now. The AI theme, since the stated purpose is to build a supercomputer, and the whole cryptocurrency digital asset theme. This news has instantly re-rated the stock. It's attracting speculative capital that seems completely detached from concerns about the Fed or high interest rates. It's a pure growth narrative play.
We're seeing similar, maybe more traditional institutional validation driving another big gainer, Open Door Technologies, Open.
Yeah, Open Door is showing significant pre-market gains too, up over 10%, also on massive volume. The catalyst here is a regulatory filing, a Schedule 13G. It reveals that Jane Street Group, which is a major and highly respected quantitative trading firm, has taken a 5.9% passive stake in the company. Now, just to be clear about the filing type, a 13G signals passive intent. It means they're just an investor. They're not an activist trying to change management or anything. That would be a different filing, a 13D.
Okay, but why is the name Jane Street so important here? Why does that specific name trigger a 10% pop in the stock?
Right. Jane Street isn't just your typical hedge fund. They are one of the most sophisticated, high-frequency quantitative trading firms in the entire world. Their proprietary models, their deep market structure analysis, it's legendary on Wall Street. So when a firm like that, which is often quite secretive about its positions, suddenly takes a public, non-trivial stake in a stock like Open Door, which is, let's face it, an online home flipper navigating a pretty treacherous housing market.
Yeah, tough business right now.
Exactly. It's interpreted by the market as a massive vote of confidence, a huge institutional validation. It implies that their sophisticated quantitative models see some kind of deep, maybe hidden value or perhaps an inflection point coming, and that stamp of approval immediately attracts buying interest from other funds, other traders who really respect Jane Street's edge. And that leads to the sharp re-rating we're seeing this morning.
Okay. And finally, another great story, this one on the green energy and maybe even national security front. Lithium Americas Corp, LAC, is also surging pre-market.
Yeah, LAC is up big, over 22% pre-market. The power behind this move is news that the U.S. government is actively seeking to negotiate an equity stake in its Thacker Pass lithium mine. Now, Thacker Pass is one of the largest known lithium deposits in the world. So why is government involvement so powerful here? Because lithium mining is exceptionally challenging. You've got permitting hurdles, environmental challenges, and just massive upfront capital requirements.
So government involvement basically solves, or at least massively helps with, those key risks.
Exactly. Government backing, especially potentially an equity stake, significantly de-risks the project, both financially and from a regulatory perspective. It validates its status as being of national strategic importance for the domestic electric vehicle supply chain. The U.S. government is, frankly, desperate to secure its own supply of critical battery metals like lithium to reduce reliance on foreign nations, particularly China. So this news kind of turns LAC from just a speculative mining venture into a nationally prioritized project that instantly improves its financing prospects and its long-term viability. It's a massive, durable catalyst tied right into that global green transition theme.
Okay, so we have all this intense microexuberance on one side, but we do need to look at the other side of that microcoin. Not all company-specific stories are positive today, and the losers can provide some really important context for the broader economy. Let's look at the negative outliers.
Yeah, the micro landscape is definitely bifurcated, and we have some important cautionary tales this morning that tie directly back into our earlier discussion on the consumer. CarMax, KMX, is among the top losers today. It's down over 20% after releasing disappointing quarterly earnings pre-market. Now, a drop of that magnitude, 20% plus, that implies either a massive miss on revenue or earnings per share, or perhaps even more critically, deeply worrying guidance about the state of consumer demand for used cars going forward.
And why should we care about Carmex specifically, beyond just their stock price falling? What does it tell us?
Well, KMX is a crucial, high-frequency, real-world indicator of consumer health. It really is. If people are pulling back sharply on used car purchases, it's a pretty strong signal that discretionary spending is contracting rapidly. Or maybe that financing conditions are becoming too difficult because of higher interest rates. Used cars are generally considered somewhat recession-resistant purchases. People often need them to commute, to get to work. So a dramatic slowdown here suggests that affordability might be hitting a crisis point for many households. This KMX signal acts as a really crucial pre-8:30 a.m. indicator that could very easily contradict a seemingly strong personal spending report that the government releases this morning. That could lead to major market confusion.
That's a great point. If the government says spending is strong, but Carmex says people can't afford used cars, which report do you trust more?
Interesting. Okay, on the tech front, the reigning champion, NVIDIA, is also trading lower this morning on pretty high volume. Is this fear specific to the stock, or is this related back to the macro environment? NVIDIA is seeing declines, in the range of maybe 1.5% to 2.8%, and it is on high volume. This weakness isn't really tied to a single catastrophic news event for the company. It feels more like a confluence of factors, mostly macro-driven, actually. First, you've just got standard profit-taking after its absolutely astronomical run-up this year. Some investors are just locking in gains ahead of the high-stakes PCE number. Makes sense. Second, as we discussed, high-growth technology valuation models are extremely sensitive to interest rates. That makes stocks like NVDA particularly vulnerable to the core PCE outcome. If PCE comes in hot, the market immediately discounts NVDA's future cash flows at a higher rate, which mechanically lowers the stock's perceived intrinsic value. And then finally, the market just continues to digest the valuation implications and maybe potential regulatory scrutiny related to its enormous market dominance in the AI chip market. There are always murmurs of potential antitrust action down the line.
Okay. And before we move on to the next set of earnings, we should probably spotlight BigBear.ai, BBAI. It's showing up as one of the high-volume stocks again today.
Yeah, BBAI is constantly listed as one of the most active stocks. It shows immense sustained interest from both retail and institutional players, even if its price movement today is maybe more muted than, say, DVLT. It's definitely benefiting from the broad, ongoing enthusiasm for the whole AI theme, but specifically, its focus seems to be on the stable, often lucrative defense and government sectors. Unlike purely commercial AI ventures, government contracts like that recent partnership they announced with SMX to enhance maritime domain awareness for the U.S. Navy, those tend to be sticky, long-term, and somewhat insulated from consumer spending cycles. The stock's high volume is also frequently fueled by analyst commentary and constant comparisons to its industry peer, Palantir, PLTR. It just demonstrates that capital is intensely focused on these AI plays that have proven government revenue streams.
Right. Okay, now we have to connect the dots here. The macro data comes out at 8:30. The micro stocks are moving wildly already.
Yeah.
But corporate earnings, they serve as that crucial bridge, right?
Yeah,
the
yeah.
sort of ground truth that either validates or contradicts the government data.
This is a really crucial section, yeah. Because corporate earnings provide these real-time high-frequency checks that are often more granular and maybe even more trustworthy than the big macro government statistics. The market will absolutely use these reports, the one scheduled for today, to try and validate or maybe disprove the core PCE and the personal spending data we get at 8:30 a.m. ET. If the official government numbers tell one story, but a corporate bellwether that interacts directly with millions of consumers tells a different story, the market often ends up trusting the bellwether more.
Okay, let's start with the ultimate consumer bellwether, reporting after the market closes today. Costco, wholesale, CoST.
Costco, yeah, it's a critical barometer of consumer financial health and habits, mainly because it deals in such large volumes of essentials. The consensus earnings per share is around $5.82. But beyond that headline revenue number, analysts are going to be scrutinizing two key things really closely. First, same-store sales figures. That tells us if their existing customers are actually buying more or less volume. Second, and perhaps even more valuable, is the management commentary. What do they say about consumer behavior? How are they preserving their margins?
Right. We have to look at the Costco print. I mean, we all know Costco. We all love the $1.50 hot dog, right? But analysts are watching something much deeper than that, aren't they? They're watching for that consumer trade-down effect.
Yeah. Precisely. That's the key insight they're looking for. Evidence of the consumer trade-down effect. Is the average American shopper still buying the giant tub of, say, national brand mayonnaise? Or are they shifting aggressively toward the cheaper Kirkland Signature private label goods? A clear shift to private label means consumers are actively tightening their belts, prioritizing value. That hurts the brand manufacturers, and it signals lower household confidence overall. Another really key metric for Costco is their membership renewal rates. If renewal rates stay high, that signals loyalty and maybe financial stability among their base. If they dip, it suggests financial stress is forcing people to cut back even on subscription costs like that. So, a strong Costco report, it could actually offset some broad macro fears later today. But weakness, especially if it follows that negative signal we already got from CarMax, would amplify those recession fears significantly.
Okay. And before the opening bell, we get a reading on corporate spending globally from Accenture ACN. This feels like the big enterprise health check.
Absolutely. Accenture reports pre-market. Consensus EPS is around $2.98. ACN is a really unique and powerful bellwether because they provide consulting and business services across virtually every major industry all around the globe. Finance, technology, healthcare, manufacturing, you name it. They have this direct, real-time pulse on overall business confidence and, crucially, corporate willingness to spend on large, often multi-year projects.
So for Accenture, what are the metrics that truly matter, maybe even more than the EPS number itself?
The key metrics here are definitely new bookings and their forward-looking guidance. For a services firm like ACN, new bookings are essentially their pipeline for future revenue. If new bookings are weak, it means corporations globally are slamming the brakes on things like digital transformation projects, cloud migrations, or other big long-term investment initiatives. That's a red flag that's far more structural than just a simple quarterly revenue miss, because it signals a lack of confidence in the future health of the global economy. Any kind of downward guidance from ACN today would be a significant indicator that corporations worldwide are tightening their belts and may be preparing for a potentially severe economic slowdown ahead.
Wow. Okay, so we have the used car market, KMX, already signaling pain, and now we're waiting on these two giants of corporate spending, ACN, and retail spending, to either confirm or deny the findings of that 8:30 a.m. core PCE report. It's a really complex data matrix today.
It really is.
Yeah.
And we also have some other pre-market reports, from companies like Jabil, which offers insights into the global electronics supply chain, and BlackBerry, focusing on cybersecurity. Those offer more sector-specific detail that adds valuable nuance. But make no mistake, ACN and COF 2, those are the big macroeconomic proxies we absolutely must watch today to bridge that gap between the abstract government statistics and the verifiable corporate ground truth.
Okay, let's try and pull it all together now. What is the integrated narrative we should take away from this really intense morning setup? And maybe more importantly, what is the strategic takeaway for you, the listener, today?
Yeah, the integrated narrative seems pretty clear. We are in a highly, highly bifurcated environment. It's macroeconomic dominance versus idiosyncratic opportunity. The macro side is completely dictated by the core PCE report. It presents this binary, really high-stakes outcome. Either it's hot and bearish for markets or it's cool and bullish. Then the idiosyncratic opportunity side, that's driven by these transformative catalysts like the DVLT-SCLX deal we talked about or the institutional validation of Opendoor. Here, capital seems willing to completely ignore the macro risk for the promise of radical immediate growth.
So if you're a market participant right now, maybe sitting on your hands waiting for the bell, what is the recommended approach? The non-gambling approach, perhaps?
Absolutely do not gamble on the PCE number itself. The high-stakes nature of this release means that taking significant positioning before 8:22 a.m. ET is essentially a coin flip. It's just guessing. The recommended approach really has to be caution and agility. It seems prudent to wait for the data itself. Observe the initial, often chaotic and volatile market reaction, which will likely be characterized by massive, rapid yield movements in the bond market first. And then listen carefully to the subsequent commentary. You need to hear from Fed officials like Barkin and Bowman later today, and you need to digest the initial signals coming from the ACN earnings call and later the Call-Est report to form a reasoned, sort of multi-layered strategy.
Right, because the most durable opportunities today might not be about predicting the number itself, but about reacting intelligently to how different sectors and specific stocks reprice in the aftermath of the release.
Exactly that. For instance, let's say PCE comes in hot and the S&P 500 drops, say, 1.5% initially. But those micro stories we highlighted, like DVLT and LAC, maybe they continue to hold most of their gains, or they only pull back slightly. Well, that tells you where the real conviction capital is flowing away from generalized macro concerns and into these hyper-specific, maybe de-risked or growth-centric narratives. That kind of intelligent observation reacting to the relative strength or weakness, that's the key to potentially generating alpha in such a volatile environment.
Okay. And as we look ahead just briefly to maybe set the tone for October, the focus doesn't really ease up on economic health, does it? The Fed has that dual mandate. We've focused heavily on inflation today. What labor and manufacturing data points are coming up next week?
No, the focus immediately shifts right from inflation to the other side of the Fed's dual mandate, employment and overall economic health. So next week, attention shifts first to the JOLTS job openings report on Tuesday. That provides critical insight into labor demand. If job openings decline sharply, that suggests the labor market might finally be cooling, which the Fed wants to see. Then on Wednesday, we get the crucial ISM manufacturing PMI. Here, a reading below the 50 mark signals contraction in the factory sector. That's a vital check on industrial health and maybe global demand.
And the ultimate pivot point for the labor market picture comes at the end of next week, right?
Yes. The week really culminates with the non-farm payrolls report, the NFP, on the following Friday, October 3rd. That will be the next decisive, market-moving event for the Fed. It provides the comprehensive look at the state of the labor market that will heavily influence their policy outlook as we head towards the end of the year. The market will be looking for that sweet spot, a consistent cooling trend, but without outright collapse.
So what does this all mean for you, the learner, listening today? It means today is a genuine test of capital allocation strategy. Do you flee risk with the herd, taking the lead from the lower futures and the rising VIX? Or do you try and chase alpha in those few specific spots where news is fundamentally re-rating value, like Open Door or Lithium Americas? The answer, well, undoubtedly depends almost entirely on the reading of that PCE thermometer at 8:30 a.m. ET.
And maybe, here is a final provocative thought to leave you with today. Consider the explosive gains we're seeing in microcap stocks like DataVault AI. They're driven by these transformative and frankly unconventional like Bitcoin-funded investments. It really suggests that speculative, story-driven capital can, at least temporarily, decouple from the overarching macro anxieties that are dictating the movement of the broader S&P 500. Now, if the Fed's preferred inflation gauge, the PCE, comes in hot this morning, yet these special situations, these micro-stories, continue to defy gravity, does this imply maybe a structural shift in risk appetite, one that prioritizes the narrative of radical growth think AI, green energy over the traditional reality of economic cycles, something to definitely mull over as the trading day unfolds?